I think most people, when they think about finance and money, tend to think of it as a pretty cut and dry sort of business. We know exactly how much money we have. We know exactly how much money we owe. We know exactly how much money other people owe us. Typically, we think that we know all these things because for our household expenses, we typically do know those things. But in business, we have a problem. In business, we have to share information about our financial situation with other people. And those other people, if they're managers, or if they're business owners, or if they're investors, or banks who are going to lend us money, they need to make decisions based upon the information we're sharing with them. And so even though it seems like it's cut and dry, there are some areas where estimates have to be made and assumptions have to be made. And wherever there's estimates and assumptions, there's going to be sometimes errors. Someone's going to use a faulty assumption as they come up with an idea of how much money is somewhere. And also, it's also just prone to abuse. Some people will lie or manipulate numbers. So because this concept is pretty new to most people who don't deal with finances all the time, I just wanted to go over some of the areas or ways in which finance becomes an art, in which sometimes we have to make estimates and guesses as to how much money we really have. The first is an area called accruals. Again, if you haven't taken an accounting class or you don't work in accounting all the time, you probably don't ever use the word accruals. What accruals mean, and you can check it out in your textbook on page 11, they've got a little gray box down at the bottom. The little gray boxes are really cool. They're just definitional statements. Whenever they fear someone who's not an expert in finance won't be sure what a word means, they put it in a gray box. In essence, an accrual is an expense or a revenue, money we're either paying out or bringing in, but that has to get recorded in a time span different than when the cash actually changes hands. This is pretty common. Sometimes people will pay us money ahead of time in anticipation of services we're going to provide to them in the future. This happens to me in my business all the time. People will give me a year's worth of rent up front, and then I provide rent to them, having already been paid. And the question is, what's the best way for me to record that? Is it best to record it all as revenue to me right now because I received the money right now? Or is it best to record it as a liability, a debt that I owe to them, and then each month as they get some rent, as they use the building, they will reduce my liability? And so because there's some flexibility in what I can do legally, there will be differences between my books and someone else who has the exact same transaction. Another good example would be companies like oil companies or maybe pharmaceutical companies that have to spend tons and tons of money up front researching their products. And then finally, after they've spent millions and millions of dollars researching, then they develop a product and then they sell it. The question is, how do they record the expense and the cost of all that initial research? Is it just a big, giant, one-time expense up front, or do they accrue it across the time period in which the money, the product's actually going to be generating money? As you can imagine, there could be some pretty strong differences of opinion on the best way to do that. Another concept is the concept of allocations. This has to do with how do we allocate certain costs to the business. For example, it's easy to allocate the cost of goods sold, right? If I buy 100 pounds of apples and then I sell them to everybody at $2 a pound, it's easy for me to say, hey, the revenue was the amount I made by selling it, and the cost was the amount that I paid for the apples when I bought them. And all of that goes to what's called cost of goods sold, or the cost of the things I'm selling. It's also easy to allocate things like hourly employees. If they work out on the sales floor, then we allocate that cost to the sales floor. What's harder is allocating management salaries or the CEO of a company. Which department or division of the company should pay for the CEO? Is it the sales division? Is it the purchasing division? If it's a company that's broken up geographically, is it the western region or the eastern region? Who should we allocate the CEO's salary to? And if we choose one, then what's our basis for doing so? As you can imagine, there could be significant difference of opinion on the best way to go about allocating those type of costs that are spread out over multiple business units. A third concept is depreciation. It's very similar to the idea of accruals. Sometimes we buy large fixed assets like buildings or equipment or machinery, and we're using them over a long period of time. That piece of equipment may be helping us generate revenue for 10 years. The question is, again, do we record it as a single big expense? Do we spread it out over 5 years, over 10 years, so that the expense is matching up with the revenue that we're creating from it? And the answer is yes, it's best to do that, but then how do you decide how long that piece of equipment should be depreciated or expensed for? Sometimes the IRS forces us to use certain depreciation schedules, but other times accountants are free to kind of make up their own schedule as long as they can justify it, and that can make a huge difference. I think there's a story in the book. I think it's in this book. If not, I'll just tell it. But a good example of this was the company Waste Management, who has millions, hundreds of millions of dollars worth of trucks and dumpsters. And what they would do is buy those dumpsters, and then they would depreciate or spread out the cost of those over a period of many years. So that as long as the truck was working and helping the company generate revenue, then they were taking a little bit of its value as an expense each year. Well, they hit a point where money was not looking too good. Their profits were down. So what they did is they decided to change their depreciation schedule. And they said, hey, if the truck will last 6 years, we think it'll last 10 years. They just came up with an arbitrary number of how long it would last. So instead of dividing the value of each truck by 6 and taking 1/6 of it as an expense each year, instead, they would now divide the value of the truck by 10 and spread it out over 10 years. So that had the effect of radically lowering their depreciation expense, which made their net income look much bigger, even though it didn't really change any cash because they'd already paid for the trucks. In the end, they had people making investments in their company on the basis of these really high profits that weren't based on any change in sales or cash. And so their choice to adjust the depreciation schedule impacted investors who in the end lost a bunch of money. The fourth concept is the concept of valuation. Businesses that have assets have to value those assets. And the question is, what's the best way to do that? For some assets, it's obvious, right? From an accounting standpoint, we often just use the cost of the asset. But some assets go up and down in value. And so we adjust the value on our books to represent that. Some things are easy to value, like publicly traded stock. You can just take the number of shares you have and multiply it by the cost per share at the stock market, and that gives you a good value. Other things are not so easy to value. And so you just have to make an estimate. And you could have two appraisers appraise a piece of property and come up with a significantly different value. It might be within a window of $20,000 or $30,000 on, say, a $100,000 asset. Well, as you can imagine, again, as investors or lenders look at your balance sheet and say, oh, look at all the assets they have. If you had 100 different properties and each of them was overvalued by even $10,000, that's a significant amount of money. So all of these things lead us to this place where numbers that we thought were hard and we thought were fixed and we thought were based in fact are really oftentimes based on estimates and assumptions. And as you can imagine, those estimates and assumptions are subject to a great deal of bias. Depending on the needs of the person making the estimate, they may overvalue something or undervalue something. I don't want you to get too worried about all these concepts and all these new terms you don't know. Stick with the chapter. This first assignment is just chapters 1 and 2. We'll learn more about these things in detail as we go forward, and hopefully that will help us just to better understand the numbers and better understand business as a whole. Good luck this week. As always, if you need anything, please give me a call or text me. My number is on the syllabus, or email me. That's fine too. And good luck.